While markets celebrated new records this week, the most revealing action happened in the names that collapsed. UnitedHealth dropped 20% in a single session. Humana fell even harder. Meanwhile, the S&P 500 hit an all-time high, above 6,900. This isn't contradiction, it's concentration. And concentration creates exploitable patterns that most investors miss entirely. The crowd sees record highs and assumes broad-based strength. Second-level thinking reveals a market where 5 technology names drive index performance while the majority of stocks trade independently. This creates an illusion of diversification that masks extraordinary risk. When passive flows concentrate in mega-cap technology, the system becomes fragile precisely when it appears most stable. This week delivered a masterclass in how human psychology creates systematic mispricing. Let me show you the 3 layers that matter. The human layer reveals 2 competing psychological regimes operating simultaneously. In technology, we see anticipation bias at scale. Investors are positioning ahead of earnings from Microsoft, Apple, and Meta, pricing in positive surprises before evidence arrives. Micron surged over 5%. Broadcom gained 2.5%. This is herding into momentum. Recent strength becomes its own justification for continued buying. But healthcare insurance shows the opposite extreme: denial and panic. The Medicare Advantage rate proposal came in at 0.09% versus expectations of 4 to 6%. This triggered capitulation selling that exceeded any rational repricing. When UnitedHealth drops 20% in one day, that's not fundamental analysis. That's forced liquidation driven by career risk and leverage. The Federal Reserve meeting operates as pure theater. With 95% probability priced for no change, the event becomes meaningless for rates, but critical for narrative management. Participants seek permission to maintain current positioning through dovish language. This is coordination masquerading as information discovery. The system layer shows how these psychological patterns create exploitable inefficiencies. The S&P 500 gained 0.41% while the Dow fell 0.83%. This divergence maps directly to sector composition and reveals the concentration risk hiding beneath index stability. Technology captured flows while healthcare absorbed catastrophic losses, yet the VIX remained subdued. Earnings season mechanics expose the system's dependency on a narrow cohort. 82% of early reporters beat earnings estimates, but this strength concentrates in technology and consumer discretionary. The Magnificent Seven represent 30% of index market cap, meaning their results determine aggregate performance regardless of broader economic conditions. AI capital expenditure projections reach $470 billion across the 4 hyperscalers in 2026. This represents a 34% increase from last year. Such spending creates path dependency. Once committed, these investments must be justified through revenue generation regardless of actual demand. The market currently prices in success, leaving asymmetric downside if AI applications fail to generate returns. Bond market behavior signals risk-off undertones despite equity strength. 10-year yields at 4.23%, with gold near record highs, indicates portfolio hedging rather than pure risk-on sentiment. Fixed income investors do not share equity market optimism, creating divergence that historically precedes volatility expansion. The Stoic approach recognizes that markets reward momentum until they punish it. This week's action demonstrates how quickly consensus can unravel when a single variable shifts outside expected bounds. The healthcare collapse shows how crowded trades unwind violently when narratives break, creating volatility that exceeds underlying economic changes. Technical structure shows the S&P holding above support at 6,830 and breaking through resistance at 6,900. However, breadth divergence indicates strength concentrates in a narrow cohort. This creates fragility masked by index stability. A reversal in mega-cap technology would cascade through passive flows and systematic strategies. The exploitable pattern here is concentration disguised as diversification. Passive indexation now delivers exposure to a narrow technology bet while creating the illusion of broad market participation. When this concentration reverses, the unwinding will be swift and severe. History shows that markets appear most stable immediately before they become most unstable. The task is not predicting timing, but positioning for inevitability while managing exposure to its absence. Discipline beats prediction every time. The crowd chases momentum and panics at surprises. We remain disciplined, recognizing that what works today creates conditions for what fails tomorrow. This is how patient capital exploits impatient psychology. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit human predictability. Download the complete Stoic exploiter methodology in the description, because markets reward those who understand the game being played.